Grupo Ignacia issued 10-year corporate bonds 2 years ago. So there are 10-year bonds issued 2 years ago. We know there's 8 years remaining. The bonds pay an annualized coupon of 10.7% on a semi-annual basis. Current annualized yield to maturity is 11.6. The current price of the bonds is closest to, so we're going to be computing PV. So we need our other four variables. What is our N? 8 years remaining, but it's semi-annual, 16. What is our payment? 10.7%. However, it's semi-annual, divided by 2, 5.35 per 100 of par. Future value is, well, par. And our interest rate factor, 11.6 on a semi-annual basis. Divide that by 2, you get 5.8. Compute PV, 95.389, 95.39. Gray Pebble Real Estate seeks a fully amortizing fixed-rate 5-year mortgage. Fully amortizing means our future value will be 0. 5-year mortgage loan to finance 75% of the purchase price of a residential building that costs $5 million. So we're going to borrow 75% of that. That's $3.75 million. Annual mortgage rate is 4.8%. Monthly payment for this mortgage would be closest to. So we have to calculate our payment. So we need our four other variables. We know our future value is 0. Our present value is the negative amount of whatever it is. 75% of 5 million, negative 3.75. Interest rate factor, 4.8%, but it's monthly. So divided by 12, you get 0.4. And it's a 5-year mortgage. It's monthly, so our N must be 5 times 12, 60 payments over 5 years. Computer payment. Since I put this in as a million, 3.75 million, the answer will come out as a million as well, 0.07042. Well, the answers are not in millions, or in dollars, so just convert it to dollars. You have a comma in there, 70,424. Melandia Corporation pays an annual dividend to its shareholders, and its most recent payment was $2.40 Canadian. Well, that is D0, its most recent payment, right? Analysts follow Melandia expect the company's dividend to grow at a constant rate of 3%. There's our G, per year in perpetuity. So we know we have a growing perpetuity. Grow perpetuity, right? Melandia shareholders require a return of 8% per year. The expected share price of Melandia is closest to. Remember, if we have a perpetuity, it's just D over R. If we have a growing perpetuity, 1 plus G minus G, and that is what we have here. Just substitute in 2.4 growing at 3%, divided by 0.08 minus 0.03, 49.44. Suppose Melandia announces that it expects significant cash flow growth over the next 3 years, and now plans to increase its recent $2.40 dividend by 10% in each of the next 3 years. Well, that is G sub S, our short-term growth rate. Following the 10% growth period, Melandia is expected to grow its annual dividend by a constant 3% indefinitely. Well, that is a perpetuity, so at that point we have a growing perpetuity. GL is our long-term growth rate. Melandia's required return is 8% based upon these revised expectations. The expected share price of Melandia's stock is, well, we have 3 years of a high growth rate followed by a growing perpetuity. So let's deal with our explicit forecast period. We're going to get 2.4 growing at 10%, discounted at 1.08. The next year it's 2.4 growing at 1.1, growing at 1.1 again. So it's 1.1 squared divided by 1.08 squared. And the dividend in the third year will be 2.4 times 1.1 to the power of 3, discounted at 1.08 to the power of 3. That is the present value of those three. Let's deal with the growing perpetuity that happens in year 3. Our dividend will be the previous period dividend growing at 1.03. So it's 2.4 times 1.1 to the 3, which was the dividend in the previous period, growing at 3%, discounted by 0.08 minus 0.03. This is the present value of that growing perpetuity, but this present value is in 3 years. So you have to discount it back by 3 years. The perpetuity itself is 65.80464, discounted at 1.08 to the 3, 52.2378. This plus this plus this plus this, 59.7078, 59.71. Consider a Swiss Confederation zero coupon bond with a par value of 100. a remaining time to maturity of 12 years, and a price of 89. In 3 years' time, it'll be a 9-year zero coupon bond. In 3 years' time, the bond is expected to have a price of 95.25. If purchased today, the bond's expected annualized return is closest to. And if you read this, if purchased today, the bond's expected annualized return is closest to what? Are we holding it to 100, or are you suggesting we hold it to 95.25? It's not clear in that last statement. It just sort of implied that, well, we mean the 3 years. You have to sort of figure that out. So that's easy, right? Future value over present value to the power of 1 over t. Future value, well, we expect it'll be 95.25. Present value, we can buy it for 89 to the power of 1 over t. How many years is that? Well, 3 years later, right? 1 over 3. Subtract out the 1, 2.288%. There it is. Grupo Ignacia issued 10-year corporate bonds 4 years ago. So there is 6 years remaining on these bonds. The bonds pay an annualized coupon of 10.7% on a semi-annual basis. Current price of the bonds is $97.50 per 100 of par value. Yield to maturity of the bonds is close to, so we have to calculate the yield to maturity, which means we need our other 4 variables. Future value is easy when it comes to bonds, always 100. Present value, we're told it's currently $97.50, so negative 97.5. What is our payment? 10.7 on a semi-annual basis. Divided by 2, 5.35. 6 years, but it's semi-annual, so there are 12 payments to be received, and you compute your interest rate factor, and you have to multiply it by 2, because what you compute here will be over a 6-month period. We need it annualized. If you divide these by 2, you must multiply this by 2 to get your answer, 11.2847. There it is. Melandia Corporation, stock trades at $60. The company pays an annual dividend to its shareholders, and its most recent payment of $2.40 occurred yesterday. So that must be D0. So we have the price, we have the dividend. Analysts following Melandia expect the company's dividend to grow at a constant rate of 3%. There's our G. Melandia's required return is. Well, our required return from a stock can come from 2 sources. It can come from the dividend, and it can come from the growth rate in the price. So our required return will be the dividend yield plus the growth rate. We had already done that in the reading, isolating R to one side. So what is D0? 240. What is our G? 3%. 240 times 1.03 over the price. That is our dividend yield plus our growth rate, 7.12%. Okay, lots of words in this question. Whenever you get a question that has a lot of words in it, it's sometimes beneficial to go right to the very end and read the stem. The stem is the question being asked. Which of the following statements is correct? And we can see that we have to arrive at a conclusion whether or not the Nifty 50 is overpriced, underpriced, fairly priced. So it gives us an idea of what it is that we're looking to get done. An analyst observes the benchmark Indian Nifty 50 stock index trading at a forward price to earnings ratio of 15. There's our forward PE. The index's expected dividend payout ratio in the next 50 years is 50%. There's our DPR. And the index's required return is 7.5%. There is our R. If the analyst believes the Nifty 50 index dividends will grow at a constant rate of 4.5% in the future, which of the following statements is correct, we have to determine whether the index is fairly priced, overpriced, or underpriced. We already know what the forward PE is, but we have the fundamentals. We have the dividend payout ratio, we have R, we have G. So let's calculate what the multiple should be based on the fundamentals. DPR over R minus G, 0.5 over 0.075 minus 0.045 is 16.67. This index should be trading at 16.67 times earnings. It's only trading at 15. Well, this index is underpriced. The analyst should view the Nifty 50 as underpriced. If you require an 8% return and must invest $500,000, which of the investment opportunities in Exhibit 1 should you prefer? And you could just calculate the present value of both, but that takes a lot of keystrokes using the cash flow keys. It's easier to just do it once, right? So take A minus B. Negative 500 minus negative 500 is 0. 195 minus 225, negative 30. This will be 0. This will be 34,092. And then all you have to do is discount these cash flows by 1.08. Well, we only have 2 cash flows, so it's just easier to do it with our calculator keys. Negative 30 divided by 1.08 is negative 27.7 repeated. 34.992 divided by 1.08 to the power of 3 is 27.77 repeated. A negative plus equals 0. We're indifferent. Italian 1-year government debt has an interest rate of 0.73%. Italian 2-year government debt has an interest rate of 1.29%. The break-even 1-year reinvestment rate 1 year from now is closest to. That's asking us to calculate a forward rate. When? In 1 year. For how long? 1 year. A 1-year rate 1 year from now. So our longer term rate in the numerator, our shorter term rate in the denominator, subtract out the 1. Just substitute in, you get 1.85311. I should note something about this term right here. What if we were calculating F12, a 2-year rate 1 year from now? Well, our numerator would be a 3-year rate. Would have to be a 3-year rate because if it's a 1-year rate, a 2-year rate in 1 year, that means it matures in 3 years. That would be to the power of 3. It would mean we'd only have a 1-year rate right now. So you would have to take the square root of this because this is a 1, this is a 3. The difference between this is 1 over whatever the difference is. So if this happened to be 6 years and this was a 2-year rate, it would be 1 over 4 because 4 years separates the 2 rates. It's just here 1 year separates the rates, so we don't have to do anything other than just divide. I don't want to lead you into thinking that you can calculate any forward rate, even a 3-year forward rate, and do it the same way. You have to pay attention to how many years separate the first interest rate from the second interest rate. A look ahead, all that is explained in fixed income. I just thought I'd put it out there now. 1.8533, there it is there. The current exchange rate between the euro and the US dollar is 1.025. Notice how it is written. 1 euro is 1.025 US. This is our spot rate. So I just reproduce it down here for you. Risk-free interest rates for 1 year are 0.75% in the euro and 3.25% for the US dollar. Those are interbank rates. They have to be interbank rates, not government rates. The 1 year US euro forward rate that best prevents arbitrage opportunities is, and we know the forward rate is going to be the spot rate multiplied by the ratio of the interest rates, both raised, both as a power term to E. Since it is a 1 year rate, we know it's e to the RT, t equals 1, so we could just ignore it, it's just e to the R. So US, we should have the US rate here. Euro, we should have the euro rate here. This is just calculator work at this point. 1.0504799. There it is there. Okay, lots of words. What's our question? Which of the following statements about the value of the investor's portfolio at the end of 1 year is correct? The portfolio has a value of $750 in both. The portfolio has a value of $25 in both. Or $17.50 if the stock goes up, $7.50 if it goes down. So we really just have to figure out what the outcomes are. Okay, a stock currently trades at $25. There is our initial price. In 1 year, it will either increase in value to 35, there is our S plus, or decrease to 15, there is our S minus. An investor sells a call option on the stock, granting the buyer the right but not the obligation to buy the stock at 25 in 1 year. So we sold a call, there's our negative C, X equals 25. At the same time, the investor buys 0.5 units of the stock. There is our H, equals 0.5. Which of the following statements about the value of the investor's portfolio at the end of year 1 is correct? Well, okay, if the stock goes to 35, what is our portfolio worth? Well, we bought 0.5 shares at 35. What is the call option worth? Well, we have a strike at 25, the stock is 35, the call option's worth $10. We're short, we have to subtract out $10, you'll get $7.50. What about the downside? Well, it's $15. We have half of a share worth $15, but the call is worth 0 because it's below 25. That is $7.50. There it is.